Hello again, welcome to MasterChartsTrading.com market recap for Friday, November 20th, 2015. This week we had some more choppy action in the stock markets as stocks recouped most of the losses that occurred last week. And this is many of the commentators are really struggling to understand this and explain this. Um, but also we will look today at the proprietary market breadth indicator index that I created, and we will look at some of the examples from 2010 and 2011 corrections, and we'll compare those with the actual bear market entries into the bear market from 1973, 2001, and 2008. Also, we'll look at the dollar, and the breakout in dollar is still holding. This, of course, is weighing on gold as it broke major support actually. And oil seems to be rebounding with a rising wedge, and this is a bearish security. And then natural gas hit multi-year lows again. And we will look at whether or not bottom picking is a good strategy in this particular security. So I presented this market breadth indicator that I created several months ago. And so first of all, what is it? What's market breadth indicator? So what I did is I took several of the momentum, trend, and breadth indicators that are available for the general markets, and I performed various mathematical manipulations on them and statistical manipulations, and then I created an index which kind of rolls them all into one. And this is the index that's in this upper pane here. Now notice that uh, if you are a trend follower, one of the easiest ways to set the bias for trading, so for example, if you want to trade long, you look for conditions where the 50-day moving average is above the 200-day moving average. So, pretty straightforward. Now, this technique of setting a trend bias by simple moving averages it happens quite often that those cross over one another and then recover right back. So for example, we can see here in those pink boxes, those are the crossovers during, for example, here during the bull market. There were several crossovers in 2010 and in 2011, and then they didn't really work out. So the bull market continued. And vice versa, here back in 1974, we had I think it was a crossover here, a small crossover, but the bear market continued. So number one, this indicator, market breadth indicator, eliminated pretty much all of those whipsaws. So that was very useful. Now, also, it helps to set the trend bias. So since we know now that the crossing over 50-day, over 200-day is not a very good indicator, it helps identify the tops and bottoms sometimes, but it also quite a bit of whipsaws. This indicator also helps to set true bias, so to speak. So if we have we will seek confirmation if this trend change, as set by the crossing over of the moving averages, is indeed true. So, for example, here back in the 1971, we had a bullish average crossover, and it was confirmed by the market breadth indicator. Continuing on in the 73, and we'll take a look at the 73 model. The 73 here also, we had a confirmation with market breadth index going into bearish territory, and we had indeed a bear market. Now, if you look at all of this, we can see that basically it's a pretty powerful indicator, and it called most of the tops and bottoms. One time it did fail. It failed right here in the 81. 81 bear market. Now this bear market was completely missed by this market breadth index. So if we count all of the major trend changes and not counting the little crossovers that were later came up to be basically whipsaws and not confirmed by the not being a major trend changes, we have here 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 major trend changes since back in 1970. This indicator confirmed 8 out of those 9. So this is about a 90% reliability. In other words, it's a pretty reliable indicator. All right, now let's take a look at some of the examples of those whipsaws and how do they relate to the current market picture. So next we'll take a look at 2010 and 2011 whipsaws, and later on we will examine major bear market changes back in 1973, in 2001, and in 2008. Okay, so this is a 2010 time period, and the upper pane here is a market breadth index. Now you can see here that we had a bearish crossover with a red line, which is a 50-day moving average moving below the 200-day moving average back in July of 2010. And we continued kind of sideways, but then we broke out here, and then the crossover back, the red line went above the green line, and we continued our bull market. Notice that market breadth index never dropped into the bearish territory, which would be below 1 here, below 2, 1.5. I set the limit at 1.5. So this was a whipsaw, and in other words, this was a buying opportunity for the continued bull market. All right, let's next look at 2011. The 2011 time period. You notice that it's a very similar picture with what we had right now. We had a very steep decline, a bearish moving average crossover, continuation here, down, and they attempted a breakdown here, which was rejected, and then a rally to the 200-day moving average. Again, notice that the market breadth index never went into a bear mode, which would have been a drop in this index below 1.5. And then again we continued up and then recovered, and we had a bullish moving average crossover. Okay, next let's look at the actual examples of 3 examples of bear markets beginning in various stock indices. All right, now this is a time period from 1973. So this picture does not look exactly the same as what we have right now, but the moving average crossover is a useful indicator still. So we had a moving average crossover back here in April of 1973, when the S&P 500 kind of continued down. Now here at the bottom here on August, looks like the price was rejected, and we had a pretty powerful rally back above the 200-day moving average. However, notice that the market breadth indicator behaved differently than in the previous 2 examples that I just showed of 2010 and 2011. Right here in July of 1973, the market breadth indicator MBI actually did drop into a bearish territory with a drop below 1.5. Now, the way I set the bear and bullish threshold is that once the bearish threshold is reached, we need to get MBI back above 4.5. So it needs to hit a 5.0 basically before I will consider that bear market has indeed ended. Now, here we can see that the MBI actually is coming up to 3.0. So let me fast forward a little bit and see what the picture looks like later on in 1973-74. Notice that MBI topped out at 4.0, and it never reached a bullish threshold of 4.5. this market index continued lower. Let me see what continued, how far lower it got. So it was a significant drop. This was a true bear market, and this is a loss of, I believe, around 50%. So this was in 1973, and then notice here, let me forward a little bit more. The market breadth indicator did finally turn positive, and we had a beginning of a bull market with a bullish average crossover, and eventually a market breadth showing that the bull market has indeed started. And then we had a very nice continuation higher. So this, even though this looks like it may have been a late move, we had an opportunity to enter right here and participate in this bull market. Moving on to 2001 bear market. Now, picture here is somewhat different than what we have right now, or what we had in 1973, and the picture will always look somewhat different. But the gist of the matter is we had a bearish moving average crossover right here in October of 2001. Very quickly later on, we had the MBI market breadth index followed suit and enter a bearish territory, and then the market basically continued lower. And there was already a, you could see that here already the action was quite weak, and then we had a support break right here, and then we had a somewhat of a pretty weak rebound. Barely, we didn't even make it to 200-day moving average, and then we rolled over and continued lower. Notice the market breadth index also never made it above the threshold for a bullish market, and it continued basically lower until finally, let me see where we bottomed out. I think in 2003. Yes, in 2003 we bottomed out. We had a bullish crossover here of the moving average, and then market breadth index confirmed the beginning of a bull market in 2003, sometime in let me see, this is July. So this is a bit of a late again, but of course, as we know, there's always chances to participate, and there were time, after this entry into the bull market, we had plenty of opportunities to partake in this bull market, which continued unabated until 2008. Okay, this is a 2008 picture with exactly the same indicators. Again, when we had a bearish moving average crossover here in December of 2007. Then we had, I think this was a support break already here. So this was already not a good sign. We had MBI crossing to bearish territory in March of 2008, and then we had a pretty powerful rebound. That's actually the reason why I think that today's picture looks more like 2008 rather than 2010 or even 2011 picture. So we came up here to the 200-day moving average, and then looks like the price was rejected at this level. I think most of you know what happened later, but let's fast forward to 2009. We had a very severe bear market here. I think it's about 60% loss peak to trough. Notice that market breadth index never even attempted to recover into the positive territory, and then finally we had a bullish market breadth indicator crossover into bullish territory somewhere in August, September of 2009. Again, you may say that this is a late entry, but as we fast forward, there were plenty of opportunities to partake in this bull market. And even as in 2010, there's plenty of correction and plenty of opportunities to enter. Now, what does this picture, the same exact indicator, look like right now? So 2015, right now. We had a bearish moving average crossover. We had a pretty significant drop, and many people say, many commentators saying that this is a double bottom. Now, it's possible that this is indeed a double bottom, but once again, as I showed just before, this market breadth index is still currently bearish, and we had a bearish crossover, and so far I have not seen a bullish threshold cross at 4.5. So I'm still considering current market picture to be in a bear market. In other words, what this suggests is that I'm looking for shorting opportunities within this possible downtrend. At the very least, I'm thinking that we're going to retest these lows. Whether or not we will hold them is a different story, but I still think that these lows need to be retested. Of course, alternative scenario is kind of like sideways consolidation and possibly a moving average crossover back into the bullish territory. And that time we will need to look whether or not the market breadth index is confirming or not the possibility of re-entry into the bull market. Once again, as of right now, I'm still treating this big rally as a bear market rally. Okay, let's switch gears a little bit and look at the bond funds. So this is a MUB iShares National Municipal Bond Fund. So it holds all kinds of muni bonds. We had a pretty sizable drop here as in December rate hike was talked about a lot, and I guess it pushed the prices of bonds a little bit lower. But I think we found support after at this breakout level, and rallied pretty hard to basically approaching all-time highs. So to me, this is still very much a bullish chart, and whether or not the December rate hike materializes finally, and this is a tiny little rate hike. So far, I'm not really seeing this in this particular chart, and I'm seeing this as I saw this as a buying opportunity, in fact, and the subscribers to my service received an alert about this. So now we're basically approaching all-time highs again. So once again, even with or without the Federal Reserve rate hike in December, this still to me looks like a bullish chart. Next on the agenda is the US dollar index. So several weeks ago, we had what I think was a breakout here above these two peaks here from July and August, and we're basically approaching 52-week highs again. Now we had several what I thought was this is a throwback and then another throwback, and I think for now we're holding this breakout. Also, the next chart I'll show is that of US dollar versus the euro, or the euro versus US dollar. And just recently, following the unfortunate events in Paris, Mario Draghi, the ECB president, reiterated that he is willing to continue the quantitative easing and possibly increase it even further. And this, of course, weighed on the euro as it again approaches 52-week lows. So let's look at that chart. And this is a euro versus US dollar as traded on Forex. So you can see that these are 52-week lows here from March of this year, and you can see that the dollar really attempted to rally here, or the euro really attempted to rally, but here in October and mid-October, really nothing happened. There was a breakdown and continued lower. So once again, we're approaching 52-week lows, and if ECB will start printing more money, sorry, I meant quantitatively easing, then euro most likely will break these supports and continue lower. And of course, going back to the US dollar chart, this will be bullish for the US dollar, since US dollar index is composed of about 57% euro. Of course, the strength in the US dollar is weighing on all kinds of commodities, and gold comes to mind, of course. This week we had a pretty, clear support break here with a close at about 1070 here, and I think this is a close below multi-year lows, so this is I think it's a pretty clear support break. Now, of course, gold is volatile, as all commodities are, so it could rebound. In fact, I think we may see we saw a rebound, or at the very least an attempt at a rebound here on Thursday. But Friday's action, I think, is showing that there is quite a bit of resistance in this area already, and there is selling. The selling may just continue, and we may see prices pushed lower to the $1,000 level even. Of course, alternative scenario is a rebound to these broken supports at around $1,100. Whether or not this will happen, obviously, remains to be seen. If you are considering signing up, I did send an alert about this potential in this drop to my subscribers, and they're sitting on nice gains in gold and GDX. So let's look at GDX next. GDX, the market vectors gold miners ETF, very volatile. In fact, one of the most volatile securities out there, and it's really difficult to trade. But if you can catch nice moves, that's very rewarding as well. So again, I sent an alert here in October about the opportunity to go short. We went short, and now we're sitting on pretty nice gains in the ETF called Dust. Again, GDX, this support here is $13 area. I pointed this out on numerous occasions. We're again at this area, at this $13 area. If we do break the support, then a measured move of at least like this much, or possibly even this much, might get duplicated on the downside. So that's another about 20% move to the downside, and GDX could potentially drop to around $10. As far as the market breadth, it's confirming the advanced decline line, advanced decline volume lines are already hitting multi-year lows. Actually, I think this is all-time lows. So this could be like a leading indicator, and then price eventually will follow as well. You can see the gold miners bullish percent index, one of the more reliable indicators. It's trending lower. It has quite a bit of room to fall. You can see here we had around the same levels, and we continued lower, and until we hit zero. We actually hit zero, and here I said, oh, that's kind of oversold, and indeed we had a kind of like a bottoming pattern. So if this support gives, and I think if there is a close below $13, we could easily see GDX in the $10 area. Okay, that's all I want to say about GDX. All right, next let's look at light crude oil, WTIC West Texas Intermediate. So last week I pointed out this breakdown, which is a support break with a close below this level, 43.21. We had a continuation lower, and I think we're getting what some like a possible rising wedge. So rising wedge in a bearish security, and this is clearly a bearish security. You can see we're hitting multi-year lows here. Rising wedge in a bearish security, once it's broken, is very bearish because it will call for continuation of the move lower. So if this is indeed a rising wedge, a break below these trend lines will almost certainly call for a retest of multi-year lows. We might actually break these lows. So if this support gives, let me just do a quick measured move, and if this is like maybe like a head and shoulders, funky looking head and shoulders, so we could just measure at the very least this much, so that's 12% from here. So that's 5% here. Then it means that we're gonna down another 10% from the 37 level. So that's a rather, and we could easily move into $33 area or so for oil. Anyway, so bear security, oil is in the bear market for now. Picking bottoms is difficult, and actually next I'll show natural gas, and it's a really good example of why one should not pick bottoms. Okay, this is a spot price of natural gas, not gas, spot price. So here in end of October, I pointed out this big white candlestick, and I thought that this is a kind of like a bullish engulfing, like an outside reversal. And I thought that we're gonna rebound possibly to like $2.55 maybe. We got very close to $2.46, but I think this rebound has failed, and we continue lower. But now this chart is a little bit strange because it looks like it didn't update at the end of the Friday trading session, because if I show you, I'm gonna show you next the actual contract for natural gas. So let me go there. This is a natural gas January contract. You can see that this contract already hit multi-year lows, and it's not yet reflected in the price of spot natural gas on previous chart. Not sure why that exactly is happening, but in fact the matter is it already is hitting, natural gas already hit multi-year lows. So if you are trying to time a long entry at this late October hammer candlestick, well, if you're able to exit out here, then wonderful. But it's really, once again, this could be like a rising wedge, and this could be a wedge break. So once again, it's really difficult to time entries in a bearish security on the long side. And then let me just show one more chart, is that of UNG, United States Natural Gas Fund. This is okay for trading. I would not necessarily hold it long term, because this is doesn't really follow that well the natural gas prices, but it did hit all-time lows just this Friday. So picking bottoms is in a bearish security. Picking bottoms is very dangerous. Please avoid doing that. All right. Very briefly, let me show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have trade alert services that are up and running. As I showed, we had pretty nice trades, several trades in oil and also in gold. And we have a trade in bonds that's also going. So it's only $19.99 per month, and you get a 3-week free trial as well. So please consider signing up. I think it's well worth the small investment in money. Also, we do have a blog, so obviously this information will be posted there. We have a video section where this video will be posted. If you go to public charts and social page, you will see that there is a link there to public charts page, and this information and many of the charts will be posted there. If you have any of the following accounts, Twitter, Facebook, YouTube, or StockTwits accounts, you can follow us there. Please subscribe to our mailing list, and you also get a special price for our trade alert services. That's it for this week's recap. Thanks for watching, and have another great trading week. Bye-bye.